Have you ever wondered how Warren Buffett became one of the most successful investors of all time? It all boils down to his unique investment philosophy that has stood the test of time, outlasting market fluctuations and economic downturns. This philosophy revolves around a concept known as value investing. Value investing is the backbone of Buffett's strategy. He is always on the lookout for stocks that are undervalued in the market, akin to finding diamonds in the rough. But how does he identify these hidden gems? Buffett doesn't just pick any undervalued stock. He looks for companies with strong fundamentals, such as a consistent and predictable earnings history. These are companies that have proven their worth and reliability over time, and yet for some reason, they're priced lower than they should be in the market. Alongside this, Buffett also focuses on companies with what he calls economic moats. Now, this isn't about castles and drawbridges. In Buffett's world, an economic moat is a competitive advantage that shields a business from its rivals. It could be a strong brand name that commands customer loyalty, a low-cost production that undercuts competitors, or even regulatory advantages that create barriers for others to enter the market. These economic moats, much like their medieval counterparts, protect the business from outside forces, allowing it to thrive and prosper. So you see, Buffett's philosophy isn't about chasing quick profits or speculating on the hottest trends. It's about careful analysis and patience. It's about seeking out value where others might not see it, and safeguarding that value with a strong economic moat. So to sum it up, Buffett's strategy is all about value investing and identifying companies with strong economic moats. It's no magic trick or secret formula. It's a testament to the power of solid fundamentals and strategic foresight. It's a philosophy that has made Warren Buffett one of the most successful investors of all time. Buffett is not just a quick player, he's in the game for the long haul. This approach is rooted in his long-term perspective on investments. He's not interested in the ephemeral, but rather the enduring. This perspective is what allows him to harness the power of compounding, a fundamental principle of investing. Imagine a snowball rolling down a hill. As it rolls, it gathers more snow, growing larger and faster with each revolution. This is compounding in action. The snowball is your investment, the hill is time, and the snow it's gathering is the return on your investment. Over time, even a small snowball can become a massive boulder. Buffett believes that this is the secret to wealth accumulation. He holds on to quality stocks for an extended period, allowing the snowball of compounding to work its magic. But how does he identify these quality stocks? This is where the concept of intrinsic value comes into play. Buffett focuses on determining the intrinsic value of a company, which is its true worth based on fundamental analysis. He looks at factors like the company's financial health, its competitive advantages, and its ability to generate cash flow. He then compares this intrinsic value to the company's current market price. This is akin to bargain hunting. Imagine walking into a store and finding an item you know is worth $100, but it's on sale for $50. That's a bargain, right? Buffett applies the same principle in investing. He looks for stocks that are undervalued, or in other words, on sale. By doing so, he ensures that he's paying less than what the company is actually worth. Keep in mind, this is not a simple process. It requires a deep understanding of business operations and financial analysis, but once you master it, you can find diamonds in the rough, just like Buffett. Remember, to Buffett, the true value of a company goes beyond its current market price. It's all about the long-term intrinsic value. Playing safe and playing smart, that's the Buffett way. Now, what does that mean? When Warren Buffett advises us to maintain a margin of safety in investing, he's referring to the practice of buying stocks at a significant discount to their intrinsic value. This cushion, so to speak, minimizes the risk of loss if the markets don't perform as expected. It's a bit like buying an umbrella before it rains. You're prepared for the worst even as you hope for the best. Next, we come to the circle of competence. Buffett firmly believes in sticking to what you know. If you're an expert in tech, invest in tech. If you understand the auto industry, put your money there. Investing within your circle of competence means you're able to make informed decisions, understand industry trends, and spot potential red flags. In essence, Buffett's approach is about knowing your game and keeping a safety net. Buffett doesn't just invest in companies, he invests in leadership. This is a cornerstone of the investment philosophy of Warren Buffett. He understands that a company's management team is the driving force behind its operations. Competent and trustworthy leaders who are focused on creating long-term value for shareholders are a significant draw for him. Moreover, Buffett looks for companies with a durable competitive advantage. These are qualities that allow a company to outperform its competition consistently, offering a protective shield against market fluctuations. This could be a strong brand name, a low-cost production method, or even regulatory advantages. These factors, management quality and durable competitive advantage, are not just checkboxes on Buffett's investment checklist. They are crucial determinants of a company's ability to withstand economic downturns and continue to prosper in the long run. In Buffett's book, a company's leadership and competitive strength are key indicators of its potential for long-term success. Buffett sees opportunity where others see risk. This couldn't be more evident than in his approach to conservative financing and market fluctuations. In the realm of finance, Buffett is known for his preference for companies that practice conservative financing. By this, we mean businesses that maintain manageable debt levels and generate consistent cash flow. He's not one to gamble on companies living beyond their means or riding on the waves of precarious financial practices. But what about when the market takes a nosedive? Well, that's when Buffett's eyes light up. He views these market fluctuations not as threats, but as golden opportunities. This is his chance to scoop up quality stocks at bargain prices, much like a shopper during a clearance sale, only in this case, the items on sale are shares of potentially profitable companies. So, in the world of investing, Buffett is a master of turning adversities into opportunities.